Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's FinTech Blueprint podcast. I'm really excited to welcome David McFarland to the conversation. He is the founder and CEO of Coterie, a fantastic insurtech startup, and we're going to learn so much from him about both the industry as well as the asset class. David, welcome to the conversation.
Thanks, Lex. Great to be here.
Absolutely. My pleasure. I want to ease us into insurance and underwriting, and maybe we can marry that with some of your early career experiences. And the way I wanted to ease us into it is to ask, what is it that people actually do from a mathematics perspective to try and underwrite risks? Like, what were the early skill sets that you developed as an actuarial analyst and consultant? And like, what were the things that you were doing?
It's funny. I really got into actuarial science from a fairly non-traditional background. I was a big fan of history and reading and stuff like that. And turns out that I just really like problem solving. And when you combine those skills, kind of that historical, learn from your mistakes type of background with applied mathematics, I think you get someone who's fairly drawn to maybe the actuarial profession. I don't want to say I was good at being an actuarial scientist or whatever, but when we actually look at what the actuary does, what they do is they price risk transfer, right? They quantify this desire for someone who doesn't want this risk or someone else to take it out, right? And what insurance companies do, insurance companies are in the business of essentially buying volatility. This risk, this volatility that no one really wants, insurance companies say, well, we'll take all of it. We'll gather it all up, and using the law of large numbers, we can handle all of these different types of volatilities, and we'll make money off of it because in aggregate it kind of resembles a certain distribution. That's not necessarily the same thing if you look at it just on an individual unit. It's a beautiful thing, right? I mean, I'm sure many of you have aggregated a bunch of data, and when you look at it, you see this beautiful gamma distribution, and you're like, wow, but no, each individual point on that is necessarily reflective of the full gamma distribution, right? Only when you aggregate it all together, because they come from a population that is gamma, do we see that gamma distribution.
When you say risk, what does that word mean? And when you say gamma, what does that word mean?
I equate risk with just volatility, right? Risk can come in a few different flavors, but that volatility is really like unwanted decrement that can really shake your life, right? Look at life insurance. It's a very simple example, right? Like, you get life insurance to mitigate the volatility associated with a decrement of someone you love, right? Decrement meaning death. And so, a wife or a husband, one of them dies, there's going to be a significant emotional and financial impact. We cannot insure against necessarily the emotional impact of that, but we can reduce the volatility that comes from the financial impact. And so we provide for that via insurance companies, indemnifying, giving money to the surviving spouse. And so that volatility that would be there from a financial perspective is mitigated because of insurance companies. Now, when I say gamma, a gamma distribution is just a type of distribution. It's just pulling like Poisson or exponential. Exponential is actually a special case of gamma. So that's all it is. I'm just using a particular distribution to say something generic.
Individually, you would be surprised by something happening because it happens kind of one time to you and you happen to roll the die and get that outcome. At a population level, like 10,000 people, some percent of people experience some sorts of things, but they start to become a lot more predictable. And so if you're a big company that is able to smooth this stuff out, that's where you get into actuarial science. Is that right?
That's right. I mean, think about it this way, right? Like, if you just see a die sitting there with a 2 on it, right? Like that's a data point. But you don't necessarily know if that die is uniformly distributed. If like when you roll it, like it's actually going to come up and the results are going to be uniform. But if you looked at thousands of individual die rolls, you would be able to tell with fairly good certainty that this dice is uniformly distributed. And so insurance companies basically say, like, look, there's populations out there, and when we group them together, we can actually get these beautiful distributions, which we can make bets on and reap a good profit or a reasonable profit because we know what's going on behind the scenes.
What is the science of trying to predict these things? Like, what are the tools available? And perhaps, like, what are the basic tools, not artificial intelligence and machine learning and gigantic data sets, but like, what are the core tools that are used in the industry?
Yeah, I mean, at a core, it's humans using things like R and Python. People use Excel a lot too on the actuarial side. But what we basically do is actuaries take in data, and using whatever tool they wish, they aggregate that data to understand the underlying distributions and make intelligent bets, basically, on how much it's going to cost to transfer this risk to the insurance companies. And we do that through a policy contract. So, Lex, I basically come to you and I say, hey, if you want me to take this risk from you, I will do it under these terms. That's what a policy contract is. And you pay me some money. And that amount of money that I need from you is quantified via the actuaries. Now, the underwriters are the ones who are basically going to say whether or not we're going to take this risk. The actuaries determine the price. Also, underwriters sometimes apply things like scheduled credits and debits to increase or decrease the price, or they will attach certain forms to the policy contract or modifications to the policy contract to make it an acceptable risk that the insurance company will take.
What were some of the early career experiences that you had in the industry that taught you these tools and taught you about the different types of risks that are out there?
The early career experiences are kind of fun. Insurance is a space where if you're smart and can really apply data, you have a world of opportunity in front of you. It's so data rich. There's so much information out there on these risks. And frankly, certain spaces, especially in the commercial insurance space, are still kind of playing like it's pre-Moneyball, right? Like where people are making decisions based off largely heuristics and what they think they know for a long period of time. And one of my favorite examples is I was working at an insurance company, and I had done an analysis of the commercial book. And there was this glaring weakness, basically using generalized linear models as well as some tree-based stuff and random forest specifically, which is somewhat relevant. And when I ran these GLMs and random forests, I basically saw that like there was this glaring outlier that made up a decent amount of the book. And I basically said like, hey, and I ran it a number of times, making sure that these conclusions were right. And I told the team, the underwriters, it's like, look, your book is pretty good, but there's this one part of it that is just awful. It's going to lead to some really bad things pretty soon. And I told them what this risk was, and they basically said, like, no way. These policyholders are like the creme de la creme. These are the ones that everyone wants. They're high average premium. They're the best stores that you can get. Everyone loves these type of people. You know, it was just like Moneyball, right? Like you're talking to these people, and it's based off heuristics, right? And I'm like, okay, like maybe I'm wrong. They go back and run your model. So I went back, ran my model. Sure enough, same results. They rejected these ideas, but math has a way of proving itself. And sure enough, within a month, maybe 2 months of these results, the insurance company got their largest loss historically, and they've been around for 100 years. And then within the second month beyond that, there was another one that I believe topped that loss from those same groups. And then the losses kept coming. I'm not an especially intelligent actuary. I'm just a guy who knew how to use data at a company that hadn't really used data up to that point in a significant way. And after those losses, they immediately changed their tone because they had understanding supported by data of what they should do. But this is the insurance space at large, especially in commercial. If you are an intelligent person who can apply data in meaningful ways, the insurance space is really for you. You can make a lot of difference.
What was a strange or unusual example of something that somebody wanted to insure?
There's a ton. Really, people in general are pretty strange when you look at insurance. The most odd things to insure it always end up in Lloyd's of London. So Lloyd's of London is really a fascinating group. Lloyd's of London, what it is it's actually a bunch of entities who have this basically an insurance exchange called Lloyd's of London, where you can get anything insured, really. You can insure your priceless toenail collection if you really want to. What is it? David Beckham insured his legs.
You can't put a price on those toenails.
You can't. But so if you really want to look at weird stuff, there's that. There's alien abduction insurance. I'm not joking. That's a thing here. And they have actually paid out claims, which doesn't. That's a thing. My favorite stories, though, probably come from workers' comp. This is more on the claim side. So you will have people just really do odd things on the workers' comp side. One of my favorite ones, though, was, I believe it was in Montana, and this one was a public one, where this quote-unquote volunteer at a national park who, as the staff said, this is not a volunteer. This is a guy who would come around the park and we'd have to tell him to leave because he'd hang around too much. He was smoking medical marijuana and wandered into a bear cave. The bear mauled him. And he claimed workers' comp because he was volunteering at the time, quote unquote. And I think it was under Montana law, it was compensable because it was medical marijuana and he was a volunteer. And so, but it was a very large case. So it all went to the court. My favorite part of this, even though that's a really comical story just from a claim standpoint, was the judge's ruling, which made it compensable because, quote unquote, bears are equal opportunity maulers. They do not care if you're high or not. And it shouldn't play a part in this particular claim.
There's a good joke about the bear market in there somewhere. I'm going to leave it for others to imagine and project into the conversation. The other thing that's a little bit difficult sometimes to get a hold of is the industry landscape in terms of the different types of insurance. So you've talked about workers' comp. There's personal insurance, there's health insurance, there's life insurance, there's renter's insurance. Can you talk a little bit about the topology of the space? What are the ways to split it up into understandable chunks and maybe some commonalities between those?
Yeah, absolutely. So at the highest level, insurance is separated between P&C, property and casualty, and really life and health. Those are the two different areas that people separate insurance into. Workers' comp is kind of an oddball, but it generally falls more with that P&C category. So the difference between the different disciplines is on the life and health side, there's a different actuarial society than the P&C side. The life and health side, it's the Society of Actuaries, and the P&C side, it's the Casualty Actuarial Society. I'm not making this up. This is comical that you have this differentiation. And there's heated debate between them about whose exams are harder.
Right. 10 points for Gryffindor in that one.
Yeah, exactly. I'm a fellow in the Casualty Actuarial Society, meaning we have to take a bunch of exams and pass this stuff so we can call ourselves actuaries and get full plumage in our headdresses. So on the P&C side, so life and health, that one's pretty obvious. It's divided between life and health. So health insurance and life insurance. Annuities fall in there as well. On the property and casualty side, you have workers' comp, which is kind of its own little weird thing. And then you have property and casualty, which is more liability type stuff. But on the property side, it's all right, we're insuring property. And then liability is just that. It's insuring against liability, claims that arise against you. And this can be either bodily injury claims, personal liability, basically you defame someone on Twitter, or property damage, right? Someone parked their car at your house and something fell off, their antenna fell off and bashed their car. So all of those things are things that you can get insurance for. Now, then there's a split between personal and commercial, right? Insuring businesses and insuring people and their homes and their cars. And so when you get into all these things, you get fairly complex type of risks that vary significantly, especially by the different types of insureds. And like, especially in the personal side, you have like preferred, standard, and non-standard. And yes, that's how insurance companies actually refer to people.
Well, corporations are people too, so it's fair. So we've laid some of the groundwork. Let's go back to your career journey. And as you learned the basics and started to apply the skill set, what led you to entrepreneurship and maybe some of the experience at ClearCover? If you could talk about kind of what you saw as being wrong in the industry or not sufficiently modern in the large insurance companies, what were the opportunities that pulled you towards innovation?
Yeah, the big thing that pulled me towards innovation was just the lack of technology and data in really the commercial insurance space. That's always been where my heart has been. And this affected the loss ratio, the expense ratio, and just like the general like happiness of people who are involved. So in workers' comp, I'll go back to there for an instance. You basically need to know what people are doing and how much they're getting paid. And how all of this data comes into an insurance company today is an agent or a broker fills out a form that says like, okay, well, what kind of class codes do you have? Okay, how much payroll is in them? And people are literally filling out this form with pen and paper and faxing it in. That still happens today, believe it or not. And what doesn't make sense is that all of these companies who they're doing this for have some type of payroll software, or at least 98% of them do, that tell you exactly who the employees are, how much they're getting paid, when they're working, and what they're doing. And so my thought, being an idealistic youth, was can we just tap into this data that exists and make the lives of everyone involved a lot easier? And the big answer was no at that time, because insurance companies had a lot of technical issues that they couldn't overcome, and it would be complicated and change up current processes, et cetera, et cetera. So I was like, okay, what if we actually did build a new insurance company that could harness the data that exists today to truly change how all this is done? Will we actually see different macro effects? For example, like right now, there are 32 million small businesses. Over half of them are uninsured. And it's because the agents and brokers don't make any money off of addressing that market. Right? They lose money when these small businesses come in. And so a lot of people have tried to change this by changing how insurance is distributed. But you can only go so far if you do that, because you're so contingent upon the insurance manufacturer, the carriers and whatnot, who actually create the products, because you can't go faster than the product can be created. And so what we did was we said, all right, we're going to change how insurance is actually manufactured. And we're going to do that for the benefit of not just the end policyholder, but also the insurance distributors, the agents, the brokers, even non-traditional partners. And in doing so, when we first launched, we brought the average bind time on these small policies from days to minutes. We were doing it in 7.9 minutes in our initial launch. And now to our Simply Bind product, which binds with just name and business address, we have an average bind time of 3.4 minutes. And so this is going to create that macroeconomic effect of ensuring many more small businesses to help reduce volatility so they can actually focus on the risks that they do want and get rid of the risks that they don't want.
Let's unpack a little bit of the industry structure as well, the manufacturer and the distributor, especially on the commercial side. Can you describe the role of the carrier and then describe the role of the agent? And one of the things I'd also love to open up is, like how difficult is it to be a carrier? How difficult is it to get licensed? And similarly, how difficult is it to become a seller and distributor?
Yeah, absolutely. So the role of the carrier it's a multi-function role, but with regard to insurance manufacturing, they're the ones who create the products. They literally create the policy forms, they price it, They file all of this with the states. The states individually approve those filings and say, yes, this product is good to be sold in the market. You have to pass muster with the regulators. And then work with the insurance distributors, the agents and brokers, to sell that product. So the agents and brokers, they basically say, okay, I'm appointed with this carrier. I can sell this carrier's product. And then they talk to the end policyholder, the person needing insurance, and they try and understand the needs so that they can appropriately match that person up with the right coverage. Now, what has happened is these agents and brokers who are very good at relationships and understanding the needs of the customers and making sure that they get coverage, it's kind of transformed into, okay, well, you do that, and you're also going to be basically a data vendor for the insurance carrier, right? Like you're going to have to fill out everything you know, and then some about the end policyholder. But that's not what agents and brokers are good at. And it's a waste of time. Like we can get way more credible data from tons of other areas. And so this problem exists. Now, I won't get into that to address the other part of your question, which is what does it take to actually become an insurance carrier? Well, there's a few ways I'll say become an insurance manufacturer, because that's the first principles thing that we've tried to do. So you can become an insurance carrier to become an insurance manufacturer, or you can become an MGA. An MGA, or managing general agency, or managing general underwriter, similar verbiage, is someone who has authority given to them by a carrier, but they don't necessarily take on the surplus, the capital requirements of a carrier. Instead, they have the surplus requirements satisfied by a carrier they work with. And so what happens, because if you want to start your own carrier from scratch, you're probably going to have to put about $100 million in a low yield savings account to ensure that you actually get AM Best to rate you a certain way. Now, that's not guaranteed. AM Best they rate people in a variety of things, but just to make sure you can get this quote unquote A rating so people will sell your product. Now, once you get that, if you decide to go the carrier route, that's one thing. If you decide to go the MGA, MGU route, that's another. There are tons of licenses and all kinds of other stuff, and then multi-state approvals that you have to go through in order to even get your product to market. Suffice to say, it's long, drawn-out, complicated, and can require a lot of capital.
So the question I have for you is around regulation, and in particular, the differences to what I see as investment management regulation with registered investment advisors that can be attached to either the state that they do their business in or at the federal level, especially if they distribute through the web, where they can be SEC regulated. And similarly, in banking, with depository institutions, credit unions, and so on, you can be a state chartered bank where you have a local regulator, or you can be a federally chartered bank and go under a different regime. And so has there been any trends in insurance regulation that would make it easier, that would consolidate things at the federal level, or are there dynamics that prevent that?
Yeah, there was a, I don't know what to call it a trend, but in the early 1900s, there was a move to actually bring all the regulation under the federal government, because it actually was I believe a Supreme Court case where the federal government found that, or the Supreme Court found that the federal government should be responsible for the regulation of insurance. And this caused a little bit of an issue, considering the states were regulating it before. And it made sense, because before, mainly people got insurance in a particular state, right? There wasn't this cross-state insurance issue. But as people traveled more and insurance companies would write in multiple states, you had interstate commerce as opposed to just intra. And what happened was the federal government actually ceded control to the states. They said, look, we'll give this up to you, but under these contingencies. And since then, since the 1900s, the states have retained control over the regulation of insurance. Now, to make things easier, in the same way that hospitals make delivering a baby easier, right? It's still a painful process. sometimes complicated. The NAIC, the National Association of Insurance Commissioners, came into existence to pass hopefully uniform laws or more uniform laws to where you could go from state to state and not deal with so many differences. Now, still, there are a lot of differences. And it varies by line of business. When I say line of business, I'm talking about like personal lines versus commercial lines, et cetera, because regulatory scrutiny is inversely proportional to the sophistication of the policyholder. In other words, if you have less sophisticated policyholders who don't have lawyers, who don't know business, who don't know contract law very well, you're going to have much higher regulatory scrutiny. They want to protect those people. If you have more sophisticated policyholders, your businesses with lawyers and risk managers and all that kind of stuff, you're going to have less regulatory scrutiny, right? They're basically like, look, you should be able to figure this type of stuff out.
The job was so easy that even the federal government didn't want to do it. That's amazing. Let's switch deeper into Coterie and how the company works. And so you said you moved closer to the manufacturing of things and really cut down the timing from multiple days to a couple of minutes. How exactly did that work? And then what kind of shape does your company have? Like what is the regulatory status and what is maybe the technology that you've built out?
Yeah. So I'll go to the first part quickly. So we're an MGA, MGU. We work with 3 different carriers who give us the authority to act on their behalf. So we file the products with the regulators, we do the claims, we do the pricing, underwriting, all that kind of stuff. And in order to do that, it was kind of a necessary part of our strategy because we wanted to control both the insurance product as well as the tech product. So we didn't want to tie ourselves to someone else's innovation curve. We wanted to be more in control of what the insurance distributor and policyholder was experiencing. And so in order to do that, we felt like we had to actually really create something special with the tech product as well as the insurance product. And so how we did that, how we made magic, right, was we brought in someone who really wasn't even from the insurance space. They had just kind of transformed how in-game sports betting was done. And using tons of data, that was their background. And so our head of data worked with me on the vision of just like, let's, using just business name and address, pull in as much data as we can to bind this risk. And sure enough, the necessary data was there. So we get in 3,000 data elements with each business name and address. And with that, we're assessing, everything from how the roof looks to how far away from a fire hydrant to what are the hours of operation and the foot traffic. And that level of detail is much more informative than what can be sent on an application filled out by an agent.
Who is giving you that data? Who are you pulling it from?
We get data from a variety of third-party partners, as well as even some from our distribution partners. Some of our distribution partners, they live where the small business lives, and they have all that data on the small business owner. And through permissions approved by the small business owner, they share that data with us so that we can have a more accurate understanding of the risk.
So you're describing the tech stack and how the company is structured around it. What else plugs into the engine? How did you build it?
Yeah, so we built the engine. Really what we have this concept called Sleuth. That is the engine. And we get this business name and address. We get 3,000 pieces of data. And then it goes into our underwriting rules. And so what we've done is we've worked with people who are very experienced in the insurance industry, these underwriters, to determine exactly what we talked about before. Right? Like, are we going to write this risk? Right? And if it follows these types of rules, we're going to write it. If not, we're not. But if it follows these types of rules, maybe we'll write it, but we're going to have some modifications to the policy terms, right? Like we're gonna add on an endorsement that says we'll write it, but only if you have this type of deductible or if you exclude this type of coverage, et cetera. And that whole process, including the pricing of the risk, running it through our rating algorithm, saying, all right, for manufacturers in Tennessee who live this far away from the water and have this many employees, you're going to be charged this much with this type of policy form. All of that happening behind the scenes takes about 2 seconds. And then they get back, the agent or broker will get back yes, we will write this at this price, or we are declining it for this particular reason. The other thing that's really cool associated with this is sometimes the data that we get is not necessarily as credible as we want. Everyone has this problem, right? And so what we do is we take the data that we actually do find credible, and we can impute data, or we can impute things based on the data that we have that's credible. And so we have these imputation models that learn over time. So we apply machine learning to our overall stack to understand, all right, I've gotten, let's say, employee count and sales, I feel really good about. I'm not so good on square footage. But we see typically that restaurants with these employee counts and these type of sales, and especially who serve French cuisine, typically have these type of square footages. And so we're able to learn over time from many quotes that we get to more accurately predict those things and make a more delightful user experience.
Yeah. And, one of the things that people often push back on new entrants in underwriting broadly, whether it's insurance or lending, is how long the underlying data sets are. Like, how many years have you been in the underwriting business? The more you've been doing it, the better and tighter your models, and therefore the lower your losses, and therefore a better business. How have you worked around that? I mean, do you have, I guess, in building the models, do you have access to historic data, or is the pipe so rich that that concern isn't even applicable anymore?
I think it's a concern that should always be considered. Thankfully, we're kind of at the beginning of actually using this data. I don't know anyone who's using this data in the same way that we're doing. So while we don't have necessarily the exact claims experience, just looking at claims, we do have a pretty rich quoting environment. So we have a number of agents and brokers who we work with, thousands of quotes coming through. And each one of those quotes is a data point that we can learn from and can form our ML models. And when you just look at that, right, and really just making a better user experience through imputation and accurate application of the data, we're learning from that very, very quickly. Now, the claims process, to your point, has a much longer tail. And so we don't necessarily, that's going to be the longer game. But things like retention, which is, can be modeled almost daily. But, if you look at annual policies, you can consider it annually. Those types of things, and non-payment and stuff like that, those types of things can be modeled relatively quickly. And with a high degree of accuracy, because you have a higher frequency of those events. Whereas claims, it's such a low frequency that you need to really invest in your model for years. And so how do you get over that? Well, how we do it is we leverage industry data to get more accurate pricing, coupled with, frankly, our experience. We're fairly experienced industry professionals. We have some amazing underwriters and actuaries on our team who know this space. And so we couple, you could call it heuristic since it's not explicitly data informed, even though it is. But we couple those industry experience, heuristics, with the data that we have to inform pricing in a way that we think is fairly reasonable. You can pull up other carriers' filings too and gain insights from those to further enhance your ability to write this business.
Awesome. Makes sense. I want to kick around a couple of questions on the business structure and the strategic structure in the time that we've got left. And that is your relationship, or the business's relationship, with partners, with agents and brokers, and then with clients as they come into the site. How do you organize? Do you hire agents? Do you serve clients just as a robo insurance experience? What's the role that everybody plays in the architecture that you've created?
Yeah, we work with agents and brokers in the same way that the Hartford, Travelers, other big insurance carriers work with agents and brokers. We also work with them through technology service providers, kind of like exchanges, if you will, and whatnot, to make their lives easier. They get paid via selling policies. So every time they sell a policy that's a Coterie policy, they get a commission based on that. And the reason why they use us is because we make their lives convenient. Again, we turn this process from days, hours, weeks to minutes, even seconds sometimes. that has really turned them onto what we're doing at Coterie, because now they can actually see this 32 million small business opportunity as just that, an opportunity, instead of what it was before, an obligation.
Gotcha. And you're able to kind of leverage the balance sheet of the carrier partners, but your ability to actually put something together is much, much faster because of your data access. And so through the machine learning that you're doing, as well as through the automation that you're doing, you're able to get the agents answers, 100 times faster than they would in the traditional paper.
Yes, that's exactly right.
Cool. Amazing stuff. I think it's super interesting. And there's this curve of kind of automation that has gone across the different asset classes in financial services. And that automation is becoming more embedded and more intelligent as technology rolls on. So I can see both of those trends also in what you're doing in terms of embedding the services more contextually, as well as using kind of smarter and smarter technology and mathematics to get answers to people more quickly. If our listeners want to learn more about you or about Coterie, where should they go?
Yeah, you can check out our website at coterieinsurance.com. Also, we're on LinkedIn, Instagram, all the other things, Coterie Insurance.
Fantastic. David, thank you so much for joining me today.
It's great being here, Lex. Thanks.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.